Good morning, students. Welcome to the subject Cost and Management Accounting. And to the first session, the Introduction to Cost and Management Accounting. Myself, CA Vibhavathavan. I'll be taking some of the sessions of Cost and Management Accounting, starting with Introduction. So let's start introduction. Basically, it covers all the concepts you will encounter during the whole subject of cost and management accounting. What all concepts you will come across? What are the techniques? What are the methods we will be using? So it's basically a compilation of whatever you will be learning in this subject over a period of time. All right. So let's start the overview of it. So of course, the introduction, the meaning, the objectives of cost and management accounting, scope of cost accounting, what all is included in cost accounting, relationship of cost and management accounting with other related disciplines like financial accounting, financial management, management accounting, users of cost and management accounting. So basically, cost and management accounting benefit who all you will be understanding here. Use of IT in costing. Now, this is very important. IT has actually eased the entire process of costing. It has automated many things. So it has actually, the technology has, increased the efficiency of the system. Cost objects. Now, this is very important. It basically it starts with the, accumulation of cost and for what we are calculating the cost. So cost object, responsibility centers you will be learning, and cost classification and much more. So let's start first of all the introduction and meaning. What is cost? So cost is the amount of expenditure. All right. So if I just highlight these things which you understand. So cost is the amount of expenditure which you will incur, whether on a specific product or a job or an order or a customer, depends upon whatever is your cost object. So for what you want to incur the expenditure, that is the cost, the kharcha, that is cost. All right. Costing. Now, what is costing? Costing is the process of ascertaining cost. Ascertaining cost means calculating of cost, computation of cost. So whatever technique we follow, that is costing. How we will calculate the cost, that is costing. So it provides the information that management needs to plan and control the organization's activities and to make decisions about the future. So basically costing helps in calculation of cost. And once we calculate cost, because it's very important for management decision making and for other users of the organization. Cost accounting. Now, cost accounting is, as the name suggests, accounting. So it's a recording of cost. All right. In different ways, we record the cost, we make different formats, we make different reports, we make different statements for management decision making. So cost accounting, as the name suggests, it's the process of accounting for cost. So it's accounting for cost, which begins with recording of income and expenditure and preparation of periodical statements and reports for ascertaining and controlling costs. So, see, the primary objective of cost you can understand is, first of all, computation of cost. We have to calculate cost. But for that, we are into cost accounting. And then the other important objective is to control the cost also. So it's equally important. It's equally important. The way the cost computation is important, equally important is cost control also. And cost control again is a continuous process. All right. Cost accountancy. Cost accountancy is application of cost and cost accounting principles. So cost accountancy means it includes cost, costing, cost accounting. So it applies everything into together, and the umbrella term is cost accountancy. So whatever you are deriving the cost, you are doing cost control, you are doing cost ascertainment, you are creating reports, you're generating reports, everything is cost accountancy. So it's basically the application of costing, whatever the techniques we are using, and cost accounting principles, which you will be learning in due course, methods and techniques, whatever we apply for what? For cost control and for ascertainment of profitability. So applying everything what we will learn in cost for the ascertainment of profitability and cost control. So that is the cost accountancy. So costing, cost accounting, more of recording, and cost accounting, basic application of everything you will learn under cost accounting. All right. Moving further. So just let me have a look at the who all have joined. All right. Good morning. Good morning, all of you. Good morning. Nice to see so many students joining so early. Good. All right. So best wishes for the start and for a happy learning. All right. So let's continue with management accounting. Management accounting is the application of principles of now. It's a management accounting again is a vast domain. It includes all the accounting, principles and techniques, cost accounting, financial accounting, management accounting. So the application of all the techniques of accounting and of course the financial management also, which we call as business finance, to create, protect, preserve, and increase the value for the stakeholders. So management accounting is taking everything together, every accounting principle, whether it's cost or financial accounting or financial management or taxation or planning. So everything, the application of all the techniques and the principles and the methods to increase the value of the shareholders at the end of the day is part of management accounting. So it's driven by management. So whatever are the objectives of management, everything is done keeping in view the objectives of the management and the organization. So management accounting gathers everything, all right, to increase the stakeholders' value at the end of the day. All right. So management accounting is an integral part of the management function. It assists management by provision of relevant information for planning, organizing, controlling, decision making. So management accounting gathers everything, all the techniques and the methods from all around. And then, of course, it assists management for planning, decision making, implementation, control, etc. Cost management. Cost management is an application of management accounting concept. So it's basically management driven. All right. Methods of collections, analysis, presentation of data. So cost management is basically assisting the management related information. So whatever management wants the information is, cost management assists that. Management wants the report in a particular format, cost management will apply the techniques and the methods in the management accounting to basically present the information to the management in their desired format or what they require for whatever objective they require. All right. So these are all the, concepts and introduction which you should know and that we have covered. Moving further, the objectives of cost accounting, ascertainment of cost. So the foremost objective of cost accounting is calculation of cost, ascertainment of cost, computation of cost, to calculate cost, determination of selling price and profitability. So once cost is ready, of course, there are many factors which determine selling price, not only the cost, but yes, cost forms the basis of it. All right. So it helps in determination of selling price also and thereby profit. Cost control, cost reduction, very, very important terms. Both of them we'll be learning. Assisting management in decision making. So everything we are doing, we are calculating cost, we're determining selling price, we are doing cost control, cost reduction. Everything is to assist the management to achieve the organizational objectives only. So everything is directed towards that. So let's study the objectives of cost accounting. Ascertainment of cost. Now, how we ascertain the cost? Accumulate. Costs are accumulated. So first you have to accumulate all the costs. Whatever cost is happening, just accumulate all the costs, gather all the costs, all right? Then assign the cost and ascertain for each cost object. So cost object could be, let us say, product A and B. So first of all, you gather all the cost, all right? You total all the cost and then you assign the cost. Some cost will go this, some cost will go to product B, some to product A, some to product B, some to job A, some to job B, some to order A or order B. So any cost object means for which you want to calculate the cost. for whatever reason you want to calculate the cost. Suppose you are making two products. So you have two cost objects, product A, product B. Now, first of all, you will ascertain all the cost, you will accumulate all the cost. Accumulate means you gather all the cost. And then you assign the cost to respective product A and B. And then whatever cost for product A and B comes, you just ascertain the cost of each cost object. So you do the total of this and total of this. So first is accumulation, then is assigning, and then is ascertaining the total cost from all sources. So whatever costs are coming from all sources to product A to product B, we will be assigning, and then finally we will be ascertaining what is the cost of A and what is the cost of B. So that is the main and primary objective of cost accounting. Calculation of a cost of whatever product or any job, for whatever we want to calculate the cost, we calculate. So cost object may be a unit. A unit means one unit. All right. So one product. A job means for one particular job. It includes a lot of activities. One job can include a lot of activities. So it can be for one job. I want to just accumulate the cost for one job. Operation, whatever we have, the process or the operation, like let us say a product passes through three processes, process 1, process 2, process 3. So I would like to have the cost for each process. Clear? And then for each department also, so we calculate departmental cost also. So there are service department, there is purchase department, there is finance department, there is stores department. Management would like to know the cost which every department has incurred, the total cost which the purchase department has incurred, the cost of production department, the cost of finance department. So that department may be a cost object. So cost object is something for which you want to calculate the cost. So I may want to calculate the cost for one product. All right. Or I may want to calculate the cost of one job order which I have received from a customer, or for one department. So whatever the cost object is, we calculate the cost. So that is the objective of cost accounting, the primary objective. So one cost, you know the cost of a product or whatever cost object you are mentioning, then we determine the selling price. So I told you that selling price are not only determined on the basis of cost, there are various market factors. There are various external factors through which we determine the selling price. All right. But yes, cost, the cost which you have computed, which you have calculated, forms the basis of it. Like if the cost is rupees 100, you cannot determine the selling price less than 100. So cost is actually giving you some ground, some base to calculate the selling price. We know that this is the cost, so selling price should be at least more than 100. All right. So that is the purpose of cost. That is the significance of cost. Otherwise, there are many factors which helps in determining the selling price. Cost is not the only factor, but cost is one of the important factors which helps in determining the selling price. Clear? So though in competitive business environment, selling prices are determined by external factors, but cost accounting system provides a basis for price fixation and rate negotiation. Clear? Now cost control, again, a very important aspect. Although if you will not control the cost will keep on increasing. And it will challenge your selling price, and it will just, the whole system can crash. So the importance of cost control is as important as cost ascertainment. All right. You cannot take it for granted that, okay, we only have to compute the cost. Cost control will happen side by side. No, it's a continuous process. All right. So how you control the cost? It ensures that expenditures are in consonance with the predetermined set standard. Now you need to understand how the costing system works. See, for every cost, we keep a predetermined standard. All right. That means this is the standard. This should be the cost, if I can explain you this way. So for any product, let us say the standard kept is as per the management objectives. The management says the cost should not be more than rupees 100. So this is the standard set. Clear? Now the department of that, whatever the department which is producing that product has to ensure that when the actual production will take place, the cost should not exceed rupees 100. So if the cost is exceeding rupees 100, that means there is a deviation to the standard. The cost should be 100. But what is the actual cost? Let us say the actual cost comes to 120. We kept the standard as 100. The cost ultimately came out to be 120. So is there a need for cost control? Yes, the cost should be 100. So whatever the cost should be is standard. Whatever the actual cost incurs is 120. Then we have to check what is the difference. So 20 rupees, why the cost exceeded by rupees 20? So the standard was set. Now the standards are set very, very, cautiously. It's not that it's not just a mere estimate. When the standard was set at rupees 100, that was also set, after expert analysis of the whole production process of many factors we keep in mind when we set the standard. It's not just a casual estimate that okay, it should be rupees 100. So when so much expert analysis was taken and the cost was fixed at rupees 100, that it should be 100, why then the cost increased to 120? So there is a need to cost control at every level, at every stage, at every point of time. If we would just let loose the cost, it will keep on increasing. Maybe in the next production cycle, it increases to 150 rupees as against 100, right? So the standard set has to be a predetermined level of costing, and then we compare the actual cost. When the actual production happens, we compare the actual cost with the standard cost, and if there is any difference, then we have to analyze the difference. So the difference we call as deviation or the variance. Why the variation? So deviation or variation. So students, I'm telling you the literal term also and the term which you should use in the cost accounting. So when we do financial accounting, we should use financial accounting terms. When we actually writing the answer in law, the corporate law, business law, we should use more of legal terminology. Similarly, when we are understanding cost accounting, we should understand in cost accounting terminologies. So you should understand and you should make use of cost accounting terms also. All right. So avoid, writing answers in normal literal meaning. So you should not write difference between, you should write there is a deviation, there is a variance between the actual cost and the standard cost. So the variance, the deviation, then we study why the variation, who is responsible for this. The cost should have been 100. Why the cost is 120? So this is cost control. Here there is a need to establish a cost control system. So for cost control, you need to understand we have to keep a predetermined set standard. That is important for cost control. We should know what to achieve. So if we have kept the standard as 100, we know we have to achieve rupees 100 cost. So this is the standard. We are focusing on this. We have to achieve this. Clear? So the expenditures are in consonance with predetermined set standard and any variation from this standard. So if cost is 120, there is a difference of 20 rupees, which is unfavorable. All right. And reported on continuation basis. It's not that once you see and then you just leave. You have to continuously monitor it. All right, monitor the cost. To exercise control over cost, following steps are followed. So always remember these 4 steps. Determination of predetermined standards. See, that will, differentiate the cost control with other control techniques or reduction techniques. For cost control, the important thing is there has to be a predetermined standard first. only then cost control can happen. So this is the very, very important step if you want to do cost control. We should know what is the target we have to achieve. So in cost control, so this rupees 100 is the target we have to achieve. The managers, the production department, everybody should know what is the target they have to achieve. That is important for cost control. Targets should be set if you want to achieve cost control. Yeah. So measurement of actual performance against the standard or predetermined standard, comparison of actual with standard, and analysis of variation and action. Action is important. Responsibility should be fixed. Accountability should be there. Who all are responsible? Why the increase in cost? Where is the lapse? All right. So that is where cost control happens. Otherwise, if you will not take action next in the next production cycle, again the cost, the cost will increase the standard. So it's a continuation process, and yes, responsibility should also be fixed. All right. So I hope you must have understood so far. So ascertainment of cost, determination of selling price and profitability, cost control, and then, of course, cost reduction. Now, what is cost reduction? Remember, cost reduction is always respect to unit cost per unit. We have to make a permanent reduction in per unit cost. There is no standard set, but we have to look into the production process. Cost reduction goes for a permanent reduction in the unit cost. Unit cost means per unit cost. All right. So if 10 rupees is the cost per unit means what is the cost to produce one unit. So cost reduction actually always strives for permanent reduction in the unit cost. Cost reduction feels that there is no lowest cost. All right. Cost control thinks that, okay, if I have kept rupees 100, so rupees 100, we have to achieve rupees 100. Once we achieve rupees 100, the standard, then everything is okay. But cost reduction people, they think there is no standard. There is no lowest cost. There is always a further scope to reduce the cost. Why rupees 100? They are challenging the standard also. Why rupees 100 is set as the standard? We can further reduce it. So cost reduction always strives for permanent reduction in the cost. Now how permanent reduction is going to happen? They will go deep into the system. They will monitor the system very, very minutely. They will break down the production process. Let us say the entire production process has 10 steps. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So these are the 10 processes a product passes through the whole process. Now the cost reduction team will see what all processes are non-value added. That means they are just adding up to the cost but not adding value to the product. Are you getting me? So they will eliminate those non-value added processes. So let us say process 1 is important to the product, process 2 is important, 3 is important, but this process 4 is actually increasing the cost, but it is not adding value to the product. So if we eliminate this, so we manage to reduce the cost a bit. That is the purpose of cost reduction. So for cost reduction, there is no minimum cost or there is no lowest cost. There is always a scope for further reducing the cost by eliminating any non-value added activities which might be happening, which are just increasing the cost but not adding value to the product. So they eliminate those processes, those activities, those levels, and manage to reduce the cost. Yeah. So let us understand now. Cost reduction is the achievement of real and permanent reduction in the unit cost of goods. So you need to understand some things and which should form part of your answer always. It's the unit cost of goods manufactured or services rendered without impairing their suitability for the use. So it's not you just keep on reducing the cost and compromising the quality, or so it should not happen. So it's just non-value added activities or levels are eliminated to reduce the cost. No cost is termed as lowest, and every possibility of cost reduction is explored. To do cost reduction, the following action is taken. How we do it? Each activity within an entity is segmented. Segmented means separated to analyze and identify value added and non-value added activities. Value added means something which is adding value to the product or to the activity that we keep. Something which is not adding value but to the product, but just increasing the cost, that we try to eliminate. All non-value added activities are eliminated without affecting the essential characteristics of the product. So if I'm eliminating this step, it should not affect the suitability of the process. All right. So if I remove this, there should be no basically burden on the other activities, or there should be no difference in the, it should not damage the characteristics. All right. And study to and conducting continuous research. So this exercise is a continuous research. So whatever activities are not required, we try to eliminate it. The most optimal way to manufacture a product or render a service. All right. Now, the last function, assisting management in decision making. So, of course, everything is directed towards management purpose only. So, whatever we are doing, costing, cost accounting, cost accountancy, whatever reports are made, whatever statements are made, everything is for assisting the management to make decisions, planning whatever they want to do, implementing, then, of course, the controlling and everything. So, planning, implementing, measuring, controlling, and evaluating of various activities. So a robust cost and management accounting system provides internal and external information to the industry, which will be relevant for decision making. So cost accounting gives a lot of information to the management to actually make planning and decision making. All right. So here we're done with objectives. I hope there should not be any doubts so far. Any doubts I can check. Cannot read the screen. Okay. You can just refresh your system, because I think there is no other query on this. Just look for it if you're able to see. Kiran, I hope now you're able to see. Moving further, the difference between cost control and cost reduction. So I just explained you, but let us see what it means. Cost control aims at maintaining the cost in accordance with established standards. This is important. Cost control will always happen, but there has to be some standards to achieve. Clear? Cost reduction is concerned with reducing cost. It challenges the standards also. So it is challenging. Let us say if we have kept the standard of rupees 100, the cost. So cost control will only try to achieve rupees 100 and its job is over. But cost reduction team is challenging this standard also. That why rupees 100? It can be further reduced. Why the standard also can be reduced to rupees 80. So cost reduction challenges the standards also and endeavors to improve them continuously. So there is always a scope of cost reduction or lowering of the cost. Clear? Cost control seeks to attain lowest possible cost under existing conditions. So for cost control, the standards are basically, they are just to achieve the standards which are kept. But cost reduction recognizes no condition as permanent, and a change will result in lower cost. So they always strive for further lowering of the cost. Cost control emphasis is on past and present, but cost reduction is always on present and future. So cost control is always on predetermined standards which are kept, and standards are kept as per past experience only. Clear? So cost control is on the basis of past. On the basis of past experience, we have kept the standards, and then they have to achieve in the present. So past and present. But cost reduction is whatever is present, we have to further reduce it for the future. So present and future. Cost control is a preventive action. Clear? And cost reduction is a corrective action. We further have to reduce it. Cost control is a preventive action. We have to, if the cost is increasing, we have to prevent it from increasing. So that is a preventive action. If cost is increasing to 120 as against 100, so cost control will prevent it from further increasing the cost. Next time it should not increase. So cost control is a preventive function, but cost reduction is a corrective function. Clear? Cost control ends when targets are achieved. For cost control, they just have to achieve the standard kept and then their job is over. But under cost reduction, it's had no visible end and it's a continuous process. They always strive to permanently reduce the unit cost of the product. Clear? So this in comparison, and these two terms are very, very important, and they are very important objectives of cost accounting, as important as cost calculation or cost computation. So students, I hope you're getting the concepts. Let's move further to scope of cost accounting. So cost accounting is applicable where, how we can use the cost accounting. Cost accounting can benefit us in which ways, all and more we will understand here. So scope of cost accounting, again, costing, the technique of calculation, how we calculate the cost is costing. Cost accounting, again, we have explained you. It's the recording of cost in the form of statements and formats, how we record the cost. Cost analysis, again, cost analysis is how we analyze the cost for cost control, cost reduction. We monitor the cost, all right. Cost comparisons, how we make cost control, cost reports, and statutory compliances. So let us understand a little bit of them. Starting with costing, we have understood costing is a technique of calculation of cost. What all techniques we use, what all techniques we make into practice that we calculate cost. Cost accounting is again the process of accounting of cost, recording of cost, statements, reports for, of course, the management decision making. Cost analysis is finding out the factors responsible for variance, the deviation, the difference in actual from the budgeted cost, and then fix the responsibility for cost differences. See, fixing of responsibility, taking action is as important as identifying the differences. So I know that the standard set was 100 and the actual cost came out to be 120. I identified that there is an increase in cost. But if I'm not fixing the responsibility, who is responsible, why the cost has increased, and action has to be taken so that this increase of cost should not happen again. So just identifying that, okay, cost has increased, it will not serve the purpose unless you take action on it, so that it should not be repeated. If it is repeating every time, what's the fun and of identifying the deviation? I mean, you're just doing identifying the increase in the cost, the difference, and then doing nothing. So it will increase every time, and it will increase in many folds in the next time. So action is as important as identification of variances in cost. Clear? So it is helps in better cost management and strategic decisions. It's important that action is fixed and identifying the variances and the deviation. So that is cost analysis. Then cost comparison. So cost comparison can happen at various levels through various forms. Like if I'm using the, alternative courses of action. So if I'm producing the product, as per process 1, there is also another way to produce the product. So what will be the cost? If I say, let us say there are 5 ways to produce a product. For process 1, process 2, process 3, process 4. So what will be the cost of different ways of producing, different method of production? So there are different methods of production. We will analyze and we will calculate the cost as per different method, and then we select what is the best method of production. So cost comparison is done. And yes, then making different products. So we are making different products, product A, product B, product C. So then we will calculate the cost for all different products, and then we compare the cost. So cost comparison can be in any form. I'm calculating the cost for different methods of production to produce the same product, or the cost for different products or the cost for the same product but at different point of time. Let us say I calculate the cost in January, then I calculate the cost in April. So every quarter I'm calculating the cost and then I'm comparing. Is the cost increasing or is the cost decreasing, and why? If the cost is increasing, why? More important is why the cost is increasing, if it is increasing. All right. So cost comparison could be alternative courses of action or different technology you are using, then you compare the cost. So technology A, technology B, technology C. So there are three ways of manufacturing the product by different technology. What will be the cost? Or the cost of making different products or activities, or cost of same product over a period of time. So there could be many ways in which management would like that you have to compute the cost and then they will compare, so that to actually strive for the best alternative course, right? So again, cost control, we have I've explained you in detail. It's a detailed examination of each cost in the light of advantage received from the incurrence of cost. What is again the cost benefit? So what is the benefit arrived out of that cost? What is the outcome? So cost is analyzed to know whether cost is not exceeding its budgeted cost. Budgeted means standard which we have kept, and whether cost reduction is possible or not. Then cost reports. So it's the ultimate function of cost accounting. At least whatever you are doing, whatever costing or cost accounting, whatever is being done, it has to generate in the form of report so that management can understand what is happening. So to make management understand, the management wants the information in proper reports. So that is again the scope of cost accounting. Different form of reports and statements, periodical basis or continuous basis, they are made for the benefit of the management so that management can actually do the decision making. All right. So these reports are primarily prepared for use by the management at different levels. Cost reports helps in planning and control and performance appraisal and managerial decision making. Then statutory compliances. So there are some cost accounting reports which are prescribed by the act or the statute or the law. So those reports also are being made as per the, giving the information of costing in different form to the law also, to the act also. So whatever reports are required by the law or the act, that is also part of scope of cost accounting. All right. So I hope you must be understanding the concepts. The difference between cost accounting and management accounting. Okay, very good. Okay, I'm glad, Rishita and students, you are getting the concepts. Um, uh, Shivani, basically, can you give exam cost control versus cost reduction? Cost control, I've given you the example who's asking this question, Suraj. Cost control is always like, let us say I am being given this an example that let us say the standard set for the cost of product A should be 100. But if the actual production of product A happens, the cost comes to 120. So now there is an increase of the cost against the standard. The cost should be 100, but actual cost came out to be 120. So it could be, I mean, standard can be kept for any level of the cost or for the total cost also. So I'm giving example of the total cost, so that let the total cost of the product is 100. That should be the cost. But when the actual production of product A happens, the actual cost comes to 120. So there is an increase of the cost of rupees 20. Clear? Now cost reduction means that if the per unit cost of product A is rupees 10, rupees 10 for 1 unit of product A. For one piece of product A, the cost is rupees 10 per unit to produce product A. So is there any scope to further reduce the cost permanently and not temporary? Clear? And cost reduction is a continuous monitoring of the cost. It's a continuous, see, in cost control, we do not monitor the production process. But in cost reduction, we break down the production process into various small levels, into small activities. Like I gave the example of, I broke down the production process into 10 activities. cost reduction goes deep into the system to make a detailed analysis where there is a scope for, cost reduction, further lowering of the cost, anything, any activity which is just leading to increase in cost, but it is not adding any value to the product, is eliminated. So that particular cost is reduced for that particular activity. Clear? So I hope you must be able to understand this. Then the difference between cost accounting and management accounting. So cost accounting only deals with quantitative, just the figures, just the cost, nothing else. It's very, very focused. It's just a quantitative study. Clear? But management accounting deals with everything. It deals with quality also, quantity also, the other aspects of the departments also. So because for decision making, you have to understand the holistic approach rather than just the figures. All right. So that is the main difference between the two. Cost accounting focuses mainly on producing a product and calculating a cost. But management accounting is basically how the information can be helpful to the management. What all is happening in the cost accounting, what can be useful to the management. So management accounting deals with any information which is useful to the management for decision making. But cost accounting means just production of a production or provision of service or calculation of cost, very, very fixed objective. But management accounting objectives are just to basically increase the value of the shareholders or the stakeholders. So any information can be relevant for management accounting, but for cost accounting, only very, very specific information is relevant and only specific information they generate. All right. It uses both past and present figures. So cost accounting is, see, whenever decision making is involved, it always involves the future aspect. So cost accounting, decision making is not part of cost accounting. Cost accounting is very focused on just the numbers. All right. But I want to calculate the cost and that's it. Then whatever is the outcome, they forward to the management for the future purposes. So management accounting is focused for the future, but cost accounting is just they are doing the present based on the past experiences. So cost accounting, the standards are set as per past experience. So cost accounting uses more of past and then they work for present, but management accounting always focuses on the future. Clear? So cost accounting development is related to industrial revolution, meaning thereby that cost accounting is coming from, bygone years when there was important to calculate the cost. But management accounting has achieved its relevance in the modern business world only. Earlier, decision making was not considered to be that important, but now decision making is as important as, other numericals or, other financial data. So decision making is now the crux of any organization. So it has achieved importance lately, but cost accounting is coming from bygone years that, since when businesses have been started. So cost accounting use the principles and procedures. So they have set principles, techniques and methods that they use. But management accounting is not driven by any methods or principles. They just work by instinct, by judgment. So management, because it's a management decision making thing, right? So management accounting is more based on instinct or judgment. But cost accounting focuses only methods, principles, techniques. They cannot just randomly calculate the cost, or they have to follow the SOPs, the systematic procedures they follow. So that is cost accounting and management accounting for you. I hope you are understanding the concept. Then financial accounting and cost accounting. I hope it's easy to understand for you since you must be doing both of them. So it provides information about financial performance. So whenever we talk about financial accounting, it's basically financial performance. Clear? Cost accounting is calculation of cost. So whatever financial gurus or financial people, they make the statements, they use the information from the cost accounting department. So whatever raw material, whatever, closing stock or whatever they are making into the trading profit or loss account, every cost is coming from the cost department only, right? So now financial accounting classifies records, present and interprets transaction in monetary terms. It classifies cost. So financial accounting people, they're concerned about financial figures, but cost accounting just focuses on the cost of any product or the manufacturing process of or how the whole coordination of many departments work. That is more important in cost accounting. It records historical data, and cost accounting makes use of both historical and predetermined cost. Now, for financial accounting, the users are different. For financial accounting, the users are generally external. The creditors, the government, the agencies, the taxation authorities, they are more focused on the financial accounting. But cost accounting is generally the management which is more concerned about cost accounting. So the users of financial accounting are generally external. The users of cost accounting are generally the management. Clear? It shows profit or loss of the organization. Of course, it's financial accounting. And for cost accounting, it's more focused on the calculation of the cost for each cost object. Financial statements are prepared under financial accounting, and different reports and statements, periodical statements, are prepared under cost accounting. All right. So that is financial accounting and cost accounting for you. Let's proceed further. Users of cost and management accounting. So mainly the cost and management accounting users are internal users. The managers use the information to know, of course, first of all, the cost. What is the cost of a product or whatever service or any cost object? And the cost center. So cost center, you will be learning in the following slides. What do you mean by cost center? To know the price of the product. So the management is interested to know the cost. Then, of course, how the price is fixed and what is the price fixed. Then to measure and evaluate the responsibility center's performance. Responsibility center means, suppose there are purchase department, production department, stores department. So what is the performance of these departments? So management is, focused and interested in the performance of these department managers also. So manager of purchase department will be called that, okay, these are the costs, why you have incurred so much, why your department cost is very high this year. So they evaluate the performance. To know the profitability product wise. Now this information can only be given by the cost accounting department. This information is not possible. It cannot be given by financial accounting department. Cost accounting department has information in different forms. So product wise cost also they have, department wise cost also they have, job wise cost also they have. So department, the management wants the info from the cost accounting department. Management wants information in different forms. And that is the one of the basic objective of cost accounting. It's very important for cost control also. So they know the profitability product wise, department wise, customer wise. And then, of course, on the basis of all this information, the cost information, the price information, the departmental information, they do the planning and decision making. All right. Operational level staff. Now, cost accounting is important for operational level staff also. Those who are working in the department, those who are working on the floor, they know what is expected out of them. Clear? So operational level staff who are working at the operations. So the cost accounting is important for them also. They know that this is the standard and they have to achieve this. If they will not achieve this, they are responsible for it. So what should be so whatever management wants, it flows down to the operational level staff through their departmental heads that, okay, this is you are supposed to do. So they know what they are expected of. All right. So the operational level staff like supervisors, foremen, team leaders, they require information to know the objectives and performance goals for them. So this is important. They know what are the performance goals for them. To know the product and service specifications. So they should know the product they are working on, what is the requirement of that product, what is the specification of that product, so that there should be no error, there should be no wastage. Clear? to know the performance parameters against which their performance is measured and evaluated, and to know divisional responsibility, profitability also. So they should know what is the departmental profitability which the management wants from the department as a whole. All right. And then, of course, the employees are cost accounting department generate the attendance records, also incentives, bonuses which are given to employees or the workers. So this inform the cost and management accounting is useful for employees also. So they are very motivated if you have good incentive schemes, they have good bonus schemes, they have good recreation facilities. So it's important for employees also if if the information is basically flown or disseminated to them. External users, regulatory authorities, they want some kind of reports from the system. So cost accounting helps to generate reports in that form. Auditors, they when they do audit of financial accounts, they do audit of cost accounts also. Shareholders, of course, management communicates to the shareholders whatever are the new orders received, whatever the huge orders they are receiving, what is the product expansion, or what probably they are exploring, they're planning to explore a new market segment, or they're planning to launch a new product. So on the basis of information from the cost accounting, management gives the information to the shareholders, the stakeholders also. Creditors and lenders, of course. So creditors and lenders are also they are also look for the information from the cost accounting department, like if they are going to give loan to the business against the inventory and the stock. So they are interested to know the performance of the inventory department, the stock department, how much stock is maintained at different levels of time, how much is the wastage of the stock. So they know that they want the information in their form, in their ways, whatever is their requirement. So cost accounting generates that information for their requirement also. All right. So that's all for internal and external users. I hope you must have got an idea about the background of how cost accounting system works, right? Then use of IT in costing. Now, information technology, especially during COVID times, IT has actually helped the economy to bounce back. Otherwise, because it was otherwise contactless, we were surviving on contactless deliveries and contactless work from home. So only IT has made it possible. And IT also has helped in the cost accounting system. IT has helped to automate, many processes. Earlier, many copies of any form, let us say if it's a good received note, or if it's a purchase requisition, or any form you will be learning in the, subsequent modules. So many copies of that forms were generated. One used to be sent to purchase department in person. Physically we have to generate a copy, a hard copy. The copy of that form has to go to finance department, one copy to the stores department, one copy to production department. Now e-copy is generated. So once e-copy is generated, by just the click of the button, you can send the e-copy to every department. You can make 100 e-copies, in within no time, just 1 second, just press of a button and e-copies can be, sent to any department, any number of times, or any number of copies also. So it has automated the process. Of course, contactless, the system increases the efficiency of the entire organization. So that, that is the use of IT. So let us understand. Information technology has changed the cost and management accounting functions dramatically with the introduction of ERP, enterprise resource planning. It's basically integration of all the departments through IT. All right. All the, like I gave the example of e-copy, that's enterprise resource planning. So it's all the departments are integrated, right? Cost and management accounting has become automated and improved. Different functional activities get integrated, right? And a single entry into the accounting system provides custom-made reports for every purpose. Now, the formats are already inbuilt into the system. It's very easy to generate reports now. So management wants the reports in no time. Earlier, they used to be, a lot of time used to be taken to generate the reports in different formats. But now it's, system is automated. All the formats are inbuilt into the system. So ERP has made the system and the, it's very easy to work now since the use of IT in the organizations, because different set of documents can be made with ease. Reconciliation of results of both cost and financial accounting has been a cumbersome process earlier, but now it's you can do reconciliation within no time in the when we use IT system. A move towards paperless environment, what I was talking about, can be seen with documents like bill of material, material requisition or purchase requisition, or your goods received note, labor utilization report are no longer required to be prepared in multiple copies. The related department can get an e-copy from the system. So it's very easy now to work in a IT-based system. All right. Further, we can say, yes, of course, internet has helped in resource procurement, mobilization, and shift towards just-in-time approach. Since so now, earlier we used to stock up the inventory in advance so that production should not be stopped. But now, since the the IT has helped the resource mobilization in a great way. Now we know when to place the order, from where to place the order. We get requisitions in no time. So just in time approach saves lot of cost and time, and saves lot of wastage and deterioration, because whenever you require, you just order just in time. Just in time means as and when you require. You don't require to stock up the inventory that much. So IT system has integrated everything, so that really helps to, if I want to purchase something, in no time I can place an order. In no time it gets inspected. The whole process is automated, and it has actually increased the shift towards just in time. Just in time saves a lot of cost. Your capital is not blocked in inventories. You can order within no time, in a shorter time. You don't have to stock up the inventories way in advance. All right. Each cost center, a cost object, is codified. Now codes are given. So if product A, product B, product C, so codes are being given for two different products. So the system recognizes the code. So you don't have to actually, mention the product specification every time. You just mention code 11. So the moment you write code 11, it will mean that this product is required. And since if code 11 is given to product A, it will automatically mean what all other specifications of product A, what raw material the product A will require, at which assembly line it will be produced or assembled. So just a code given to a product solves everything. It eases the whole mechanism. So coding has actually really helped in IT. All related costs are assigned to the cost objects and cost centers using assigned codes. So whatever cost is coming, okay, give it to code 11, give it to code 11. So whatever costs are coming, they are just assigned to the products which are given different codes. So the entire department is working on codes. This automates the cost accumulation and ascertainment process. The cost information can be customized as per the requirement. For example, when an entity manufactures or provides services, managers are able to receive information job-wise, batch-wise, process-wise, cost center-wise. So when you have the coding system, it's very easy to generate information, right? And IT enables an entity to monitor and analyze each process of manufacturing or service closely to eliminate non-value added. So basically, it's a process of cost reduction. So IT really helps in all those things to identify what are the non-value added activities, what can be eliminated, how can we further reduce the cost. So IT is really very helpful in easing the cost accounting mechanism now. All right. So I hope you must be having an understanding of how the system works. Installation of costing system. Now, since we have so many benefits of the cost accounting system, the users, the formats, the statements, the generation, the use to the management, we should have a good cost accounting system. So how and when it's required? Let me see if there is no let me see, job. Okay. Shivani, Shivani, see this, it's not about the weightage of marks of this chapter. It's about whatever you are learning in this chapter. will clear your concepts, whatever you will be learning in subsequent chapters. It will give you an idea how the cost accounting system works, what is the scope of cost accounting, what are the methods and techniques which you will be using in the subsequent chapters. So it will clear the understanding of the subject. It's not always that if the weightage is given to some chapter, only then it is important. This chapter, the introduction to cost, is so very important to understand cost accounting as a subject, that how the whole mechanism works. In the subsequent modules, you will be learning only of that particular activity or a particular process or a method. But in this introduction chapter, you will understand how everything is integrated, how we are using cost accounting, why we are using cost accounting, what is the significance of cost accounting, and what all are the what all types of cost will be there. We'll be just doing in subsequent slides. All right. So I hope you have answered your query. Layoff generally, yes, layoff could be cost reduction. Of course, it's not cost control, because cost control, we need to have a specific predetermined standard, and we just are able to achieve that. All right. Cost reduction, you can, yes, we can say it's part of cost reduction, since it has to be a permanent reduction. So it cannot be cost control for sure. All right. Moving to installation of costing system. The objective of setting up the costing system, it is being introduced for fixing prices, offer cost control. Nature of business and activity, I think is self-explanatory. The industry in which business is operating, according to the cost information requirement, cost accounting methods are followed. So whatever cost accounting system you have to install, you have to see which business you are into in. So if you are into medicine business, pharmaceutical business, we have to follow the batch costing, because medicines are produced in batches. One medicine strip is not produced. 1,000 strips of medicine of one particular medicine is produced in one lot, in one batch. So it depends what type of business you are into in. If you are into a construction business, then there is a separate contract costing, which the method, that particular cost accounting system should be installed in your organization. So it depends upon business to business what type of costing system you require in your business. All right. Organization hierarchy, of course, so there are different levels of management. So top management, strategic management. So accordingly, a cost accounting system, what is the requirement of the management? What type of reports they will be wanting from the cost accounting department? That also actually is dependent what cost accounting system you want in your organization. Then, of course, knowing the product, again, which type of costing system you have to implement. If you have a byproduct, so if it has a byproduct and you want the costing of a byproduct also, so that particular cost accounting system that gives you the breakup of main product and byproduct that you require in your organization. So it depends upon the what type of product you are into. All right. Knowing the production process, of course, the whole production process, how many processes there are into to complete one production cycle. So one product goes through how many processes. So that again, it depends upon what type of costing system you require. Information synchronization, you want the information to be shared by within how many departments, between how many departments. So that again, calls for what type of costing system you require. So it depends upon your business, the product, the management objectives, the integration of your departments, at what level the departments are integrated, at what level you want the departments to be integrated. So it all depends what type of costing system you require. All right. Moving further, the method of maintenance of cost records. So how you are, in what format you require a cost records, what type of statements the management would require. So the format of report, the format of periodical statements, the format of the store's ledger which they keep, what all records the management would require the different departments to keep. Again, all that calls for a particular cost accounting system, and statutory compliances and the audit. So again, what are the requirements of the statute or the law? Accordingly, that your system should be able to generate that type of report. So that calls for a particular cost accounting system. Moving further, Okay, so now cost objects. Clear? Now we are going into, deep into the cost accounting, what all is relevant for cost accounting. And, without these concepts, you cannot function cost accounting. So you have to understand in that way. So what is cost object? Cost object means for what you want to calculate the cost. I want to calculate the cost for product A, product B. So that product A, product B is a cost object. Suppose I work on customer orders. I get customer order one, customer order two. So I want the cost, whatever whatever I'm doing for customer order one. What is the cost for customer order one? So the customer order is my cost object. Clear? Let us say the product passes through three processes. All right. Process one, process two, and process three. So I want to know the cost of process one, process two, and process three. So every process is the cost object. So what for whatever you have to calculate the cost, that is called as cost object. So it could be a product. If you're a service organization, it could be that service if you're giving to a customer. Then a project. If you're dealing in, construction business, you have got the road project, you have got the building project. So that road is your cost object, that building is your cost object, meaning thereby the cost object for which you want to accumulate the cost and assign the cost, for which you want to know the total cost. That is a cost object. It could be a product or a service or a project or a construction project or a job order or whatever you want to calculate the cost of. Clear? So product, a smartphone, you want to calculate the cost of a phone or a car or a book. So that is a product. Service, if I'm giving as a chartered accounting, if I'm giving as a service to client one, client two, client three, so that is my cost object. All the clients are my cost object. I want to generate and calculate the cost for the client one, client two, or client three. Then utility. So any type of utility payment, any project, any road project, any activity, so there are different activities. Let us say in service organization, there are different activities. What is the cost for each activity? That again is a cost object. For a process, I just explained you, if the product passes through many processes, I want to know the cost of each process. Then the department, of course. So I want to know, the management wants to know the cost of purchase department, the cost of finance department or stores department. So that department is also a cost object. So meaning thereby, whatever for what you want to calculate the cost of is the cost object. Clear? So that is the cost object for you. So here we'll just take a break of 5 to 7 minutes and then we'll come back and then we'll continue after that. All right. So just have a short break of 5 to 7 minutes. All right, students, can you hear me? Let's continue from where we left. I hope you can hear me. Okay, let me see if there are any queries or doubts. Industrial Revolution. But the Industrial Revolution is who has asked this question? Soumya Kanta, Industrial Revolution, basically when we shifted, the transition from manual to machines. Earlier, with in the I don't clearly remember, but I think in the late 1700th century and early 18th century, everything was made by hands, manual. Everything was it was an agriculture economy. Everything was done by hands manually. Then it shifted the focus to industries, manufacturing by machines. That is industrial revolution. So from that period, we were calculating that they must be calculating the cost and everything. So that's why we say since industrial revolution. All right. So when the steam engine was, introduced and everything. So that means when we got mechanical, from manual to mechanical. All right. So that means industrial revolution. Okay, I thank you, Shivani. Glad that you have understood the concept. Suraj, I cannot use Hindi language as such, but I'll try. I'm using very simple English, very simple terms. But see, since it's cost accounting, as I said, you should be familiar with some cost accounting terms. So you might not be understanding the costing terms which I must be using, but in the course of time, you will get familiar with these terms. So I'm using more of cost accounting terms rather than the English terms, right? So these cost accounting terms are important. You should be familiar with these terms. So it's okay. It's the first session. Maybe you are, coming across these terms for the first time, but gradually you will get an understanding. All right. Cost unit. So cost unit basically how we denote the cost. So if the the product I'm manufacturing is in kgs, so unit will be in kg. If it's a liter product, the unit will be in liter. So let us say if the milk is supplied or the juices are supplied, then the cost unit will be in liter. So the cost rupees 10, the total cost rupees 10 for product A, and the product is in liquid form. So it will be rupees 10 per liter. Or if it's a labor based organization, a service organization. So it could be per hour. Let us say if an organization which is providing the services of nurse or maid or helpers, then it will be cost per hour. So unit means whatever you are into that business and for what you are denoting the cost in that form. That is a cost unit. So unit is a unit of product or a service or time or a combination of these. So cost units are units of physical measurement. How you're measuring that cost. So that physical measurement, like are you in numbers? Let us say if it's bicycle or if it is cars. So it will be per car, per unit, 1 unit of car. That means one number of car. Or it is in weight, kgs or kilograms or grams or whatever, milliliter, area, volume, it's like square feet or square yard or yards or volume or length or like in meter or millimeter. If it's a clothing organization, it will be rupees 10 per meter. If you go and buy a suit length, it's rupees 1000 per meter. So the unit is in which you are denoting the cost. So if it's an automobile, it's number one, number two. So we have 10 cars, we have 20 cars. Cement, it's ton per bag. So a combination, ton per bag. Chemical, liter or gallon or kilogram or ton. Power, kilowatt hour. Steel, again ton. Transport, passenger, kilometer. So it's a combination. Passenger and kilometer. So it's a combination of two units. Clear? And in like hospitals, it's patient per day. All right. So again, a combination of two units, patient and day. Gas, cubic feet. So there are different units which the cost can be denoted into. All right. These are cost units. Cost driver. Cost driver is a factor or a variable which affect level of cost. That means the reason why the cost is incurred. As simple as that. Cost driver is what is driving the cost. Why the cost is being incurred. So if the cost is increasing, why? So the cost driver is what is causing the cost, due to which the cost is incurred. Why the cost is happening? So that cost driver. Because of that, the cost is happening. So the cause of the cost, the reason for that cost. Generally, it is an activity which is responsible for cost incurrence. So exactly, that is the activity which is happening. So whatever activity due to which that cost is happening, that is cost driver. An activity may be an event or a task or a unit of work. Examples: number of machine setups. So whatever the numbers of the machine setups will increase, the cost of machine setups will increase. So if you will, let us say there are 50 machine setups you are doing in a day, so the cost will be accordingly. If you are not doing any machine setup, there will be no cost of machine setup. So because of this activity, because the machine is setting up, the cost is being created. If no machine is setting up, there will be no cost. So cost driver is the machine setup. So the number of times you will set up the machine in a day, the cost will be accordingly. So why the cost? Because of setting up of machine. Clear? So the reason, the activity why the machine is being why the cost is being generated. So that is cost driver. So I can give another, a non-costing example. Let us say you're consuming electricity. So electricity is being consumed, and it is the bill is generated as per the units you are consuming. So if you're consuming 10 units of electricity in one day, the electricity will be generated. If you're consuming 20 units, the electricity will be increased. If you are not using any electricity, if there are no fixed charges, presuming, so if you are not using any electricity, there will be no bill. If you're not using the any activity, if you're not using, there will be no cost. Because you are using it, because you are doing it, that's why the cost. So cost driver is the reason, the cause why the cost is happening. That is cost driver. What is incurring the cost? Clear? So that is cost driver. I hope you have understood the cost driver. Moving further, responsibility centers. I think some of them as the responsibility centers. So now we have moved to responsibility centers. I hope all the concepts are clear. All right, go. So responsibility centers. See, there are many departments. Let me try to explain you like this. There's purchase department, there's finance department, there's inventory department, there's production department. So all these departments are a cost object in itself. The management is focusing on, so there will be a purchase head, the departmental head. There will be a finance manager, the head of the department of finance. There will be inventory or stores manager who is heading the stores department. All the departments are the centers, the responsibility centers. Why? Because they are in itself, they are responsible to the management. They are taking care of their department as a whole. They are responsible for their department as a whole. That's why it's called the responsibility center, because they are responsible for the performance of their particular center or department. Those are responsibility centers. So every department in an organization is a responsibility center. So it's not internally also. Let us say there is a head office, it has 10 branches. So every branch is a responsibility center also. So it's not that only internally within an organization, if there are 10 departments, they are responsibility centers. If there are 10 branches across, let us say there are 10 branches in 10 different states, every branch is a responsibility center. Every branch must be having a branch manager, and that branch manager is responsible for its branch. So that branch is also a responsibility center. Is it clear? So there are public sector undertakings. I hope you know the public sector undertakings. There are different public sector undertakings in India. Every public sector undertaking is a responsible center. They are answerable to the government of India. So all the responsibility centers, they could be inside the department, inside the organization, or outside the organization, but they must be accountable to one authority. Clear? So if there are 10 departments inside the organization, they are answerable, responsible to the management. If there are 10 branches, they are responsible to the head office. If there are 10 public sector undertakings, they are responsible to the government. So every branch or every company or every department, they are responsibility centers in itself. Clear? So the responsibility centers are, that is, they are responsible for their center. Could be at their department, or could be their company, or could be their branch. So when it is decentralized and people are working and are responsible for their departments or their companies, it is called responsibility center. All right. Now let us try to understand to have a better control of the organization. So basically decentralized. Decentralized means everybody has been split and segregated, that you take care of your particular center or department or company or branch. Yeah. Management delegates the responsibility and authority to various departments or persons. These departments or persons are known as responsibility centers and are held responsible for performance in terms of expenditure, revenue, profitability, and return of investment. So every manager, every departmental head, every head of that particular responsibility center is responsible for the performance of their particular department or center to the management, or whatever, to the head office, or whatever is the responsibility center. So they're accountable, they're answerable for all the expenditure they do, they're answerable for whatever revenue they are generating for the company, they're answerable for the profit they are making, they're answerable for any investment they are doing, what is the return they are generating. So for everything they are doing in their department, the head of that department is accountable or answerable to the top management. Clear? Performance of these responsibility centers are measured against some set standards. So the management has set a standard that this should be the maximum expenditure for purchase department, and this should be the maximum for finance or inventory, or so on. Or this particular branch should generate a revenue of 1 crore in this year. So whether you have generated 1 crore or not, that branch manager is responsible to the management if he does not able to generate that 1 crore of revenue, which was set as a standard for him. Clear? So that is how they are measured and evaluated against organizational goals and performance targets. So there are different types of responsibility centers. Cost center. Cost center is responsible only for cost. So there is no profit, there is no revenue, there are no sales. Cost center means whatever centers are there, they are just responsible for the cost under their control. So the purchase department is only responsible. So that is a cost center. So the center where no sales are happening, that is a purely cost center. Inventory department is a purely cost center, only generates the cost. Clear? Finance department, again, no sales, but sales department only generates sales. They are responsible more for sales. So it's a revenue center. So cost center where only costs are incurred. Purchase department, production department, inventory department, they are only the cost centers. They are called as cost centers because only costs are incurred there. No revenue, no sales are happening there. Clear? So two types of cost centers are there: standard cost center and discretionary cost center. So production department, inventory department, they are standard cost center. Everything is set. If 1000 kgs, so let me explain you this way. If 1000 kgs of input are going into the process, 500 kgs of output should be measured. So standard cost center means when input is identified, is specified, and output can be measured. So when there is a cost benefit or outcome can be measured. That is a standard cost center. So production department is a standard cost center. The input, whatever goes into the production process, is specified, and out of that 1000 kgs, how much output will be generated, that is also, that can be measured also. So that is a standard cost center where there is a standard procedure of measuring input and output. Discretionary cost center is where you cannot measure the cost and benefit. Clear? So the best example is advertisement. So there is a advertisement department. That is a cost department. You can say in a way, if it's only cost. So in advertisement department, you are generating the cost, but you are not able to measure how much sales have been increasing because of that advertisement. Can you measure exactly what increase in sales is due to advertisement expenditure? You cannot measure exactly the cost and the benefit of advertisement expenditure to sales. So it's a discretionary cost center. So understood? Standard cost center means when input output ratio can be specified and measured. Discretionary cost center is when you are generating the cost, but you cannot measure it in outcome. That how much sales is increasing due to this advertisement, right? So this is discretionary cost center. I hope you've understood this. Revenue centers, they are responsible for generating the revenue. More of revenue. It does not mean that they will not generate the cost, but majorly they will generate revenue. Clear? So the sales department is the best example for revenue center. They are responsible for the sales. Only most of the time the sales, of course, they have some expenditures also like sales commission, but that is not very major. Majorly it will be called as revenue center. So revenue center does not mean that it will be only revenue and no cost, but it means majorly it is responsible for generating sales revenue for the company. All right. So revenue center. Then profit center, the branches are the best example of profit center. So branches are have the responsibility of generating the cost also and sales also. So they generate the cost also. So because it's a separate branch, so cost also will be there, and they will make their own sales. So they will be having their own profits. Though any center or department which is generating profit also, that means cost has to be there and sales also be to it. So branches is the best example of. So every branch is a profit center. Clear? So they are responsibility centers which both have the responsibility of revenue and expenditure. Since managers of profit centers are accountable for both cost and revenue, profitability is the basis for measurement of performance. So every branch manager will be answerable for their performance in terms of how much profit their branch has generated. All right. So examples are decentralized branches of the organization. Investment centers, very good example. The public sector undertakings of central government. See, branches generally don't make the investments. Branches are just responsible for generating profit, but only the head office makes the investments. But the investment centers means they will be generating cost also, revenue also, and they are allowed to make investments also, and they are answerable for the return on investment, right? So the public sector undertakings are the best example. They are mutually exclusive. They work under the government leadership, but they are in the organization in their own way. They can make investments also, and then they are answerable for return on investments they are making. So they are called investment centers. So I hope you have got an idea. Let's just have a quick look. Cost centers, only cost is there. Revenue centers, only majorly revenue. They are responsible for the revenue, like sales department. Profit centers, the branches which generate cost also and revenue also and calculate profitability. Investment centers, they do cost also, profit also, revenue also, and investment also. All right. So now coming to classification of cost. Let me see if there is any doubt. I explained you, Rashi, discretionary cost center, where you cannot have where you cannot have, direct relationship between input and output. I just gave you the example of advertisement or research and development. You are doing research and development, you are incurring cost, but can you actually measure what is the outcome of that research and development in the performance of the organization as a whole? Let us say profits are increasing, sales are increasing. So can you exactly measure how much that research and development expenditure has led to the increase in sales or profit? You cannot measure. So that is why it's a discretionary cost center. Clear? Where costs are incurred, but you cannot measure the outcome of it in specific terms. All right, in exact terms, you cannot measure. So classification of cost, we have, you should understand the elements of cost are material, labor, and other expenses. So there are three elements of cost. So material, again, direct, indirect, both. Employee, direct labor, indirect labor. Expenses, direct expenses and indirect expenses. You should understand all the indirect portion will lead to overheads. So everything which is indirect is actually overheads. So indirect is also called as overheads. This you need to understand. These are the terms now which you will be coming across in your respective modules. This is the understanding which you require in this module. It's not about the weightage of marks. It's about what you are learning in this module is very important to have an understanding of what you will be understanding in the later modules, right? So whatever indirect cost, actually it means overhead. And the left is the direct material, direct labor, and direct expenses. So overheads are three types: production, administration, and selling. So let us just understand it a bit in detail. Direct material, direct labor, direct expenses, anything which you are, basically which is identifiable in a product is direct material, which you can directly identify. So let us say if it's a pen, all right. So in this pen, what you can see, what you can identify, the plastic, the raw material, that is a direct material. The printing, the ink, I can calculate exactly how much the sheet of raw material, that plastic must be used on this on this pen. So that is the direct material. Now the pen must be manufactured under electricity. So this electricity bill, can I measure how much electricity is used on this pen? I cannot measure. That is indirect. Clear? So any form of indirect thing which is used on any thing are the overheads. So material, if I'm talking about material, any material which is directly identifiable on any product or a service is called direct material, which you know exactly how much material is used on that product. That is direct material. Yeah. Now, direct labor, the workers who are actually working on the product is called direct labor. Clear? So the workers who are actually working in the manufacturing product, who are working on the product, let us say a table is being processed, a table is being manufactured. The workers who are actually working on the tables, painting the table, fixing the nut bolts, assembling the tables, the workers, the whatever we are paying to those workers is direct labor cost. All right. Now a supervisor is coming and have a look at the factory. Can you measure exactly how much salary the supervisor, whatever is getting, and how much time he is allocating to one table, two table, three table? We cannot measure. That is indirect labor. Something we cannot directly identify with one product is indirect. Something which we can directly identify with that product is direct cost. So direct material, we can directly identify. Raw material is a direct material. We can see and we can exactly find out that how much plastic must be used on this pen. But there are many small nuts and bolts which is not very practical, and reasonable to identify the cost, that we can keep as indirect material. All right. So labor, I explained you, the workers directly working are direct labor. The supervisor, the foreman who is working on 100 machines at a time, we cannot allocate how much time he must have given to one machine, two machine, three machine. Indirect labor. Here, direct expenses, again, any expense which is incurred on that particular product or that particular manufacturing is direct expense. Electricity bill, telephone bill, rent of the factory. We cannot measure exactly how much is being used on one product. That is indirect expense. So every overheads, other expenses are all indirect. Let us say there's a very good example, higher charges of a machine. If a machine is being hired specially for a product, it's direct expense. But if if the factory is taken on a rent of rupees 50,000, and that rent of that factory is indirect expense. So whatever can be directly identified with the product is direct cost, maybe material or labor or expense, which cannot be easily identified to a product or a service is indirect. Clear? So that is the broadly meaning of direct and indirect. By nature of element, again, indirect I've explained you, which do not normally form part of the finished product. Let us say cotton waste, lubricant. So we are oiling, we are putting one drop of oil that we cannot measure. So indirect, all right. Indirect labor means where labor cost cannot be allocated or apportioned as per the two different cost objects or cost centers. So something which cannot be allocated is indirect. So any paid salaries paid to the foreman or the supervisor or the maintenance workers, because they cater to many machines, many products at a time. It's not possible to measure how much time they were on the product A or product B. So indirect. Indirect expenses, again, factory heating, lighting, telephone repair, maintenance, all are indirect, which are generally happening, but you cannot allocate directly to one product that how much is done on product A or product B. That is indirect. Clear? Moving further, overheads. So overheads are actually indirect cost. Indirect material or indirect labor or indirect expense. So whatever is happening in the factory area is called production overheads or works overhead. So production overhead, factory overhead, works overhead means the same. Administration overhead means office expenses, office rent, office telephone, office salaries, administration. Selling means which is happening for marketing of a commodity. Advertisement, salesman commission, they are all the selling department expenses. All are indirect again. Distribution, that means logistics. Clear? Warehouse charges, loading, unloading, packing, all are distribution. So there are categories of indirect cost. Production, that means any expense happening in the factory area. Administration, any expense happening in the office area. Selling, any expense happening in the selling department, sales department. Distribution, any happening in the warehouse or distribution or logistics is the distribution overhead. So this is the classification of indirect cost into different overheads. Overheads are called as indirect. And what are indirect? Which are not directly allocated or which cannot be directly allocated to any product or a service, but which are happening generally. Clear? Or which cannot be measured exactly. Those are all indirect. So coming to functions, direct material, direct labor, direct expenses is called as prime cost. So direct prime cost is nothing but direct cost. Okay. So to the direct cost now, indirect material. So indirect material, labor and expenses, factory. So factory indirect material, factory indirect labor, factory indirect expenses. Again, they can happen to administration overheads also, and they can happen to selling and distribution also. Clear? So indirect material in the factory means that oil and lubricants, stores and spare parts, small consumable stores, nuts and bolts, they are indirect material. You cannot measure how much is, they're so small in value that they cannot be, it's very difficult to allocate to one product. 2 nut bolts in product A, 3 nut bolts, it's not very feasible. Yeah, so we take it as indirect material. So oil ka dabba, oil tin or a lubricant ka, tube, everything is formed as indirect material. Indirect labor, supervisor salary is indirect. You cannot measure how much time supervisor has given to product A, product B, product C. It's not easy to calculate. So indirect labor, indirect expenses, all those, rent of the factory, lighting of the factory. So the overheads, which cannot be allocated to any single product, are indirect. Now, coming to administration overheads, under administration, what could be indirect material administration? Stationery item, pen, paper, eraser, scale, those are markers, pins. So those are indirect material in office area. Indirect labor, manager's salary, office staff salary, indirect labor. All right. Indirect expenses, postage and telegram or office rent, office lighting, indirect expense. Selling and distribution, selling indirect material. So could be, packaging, cartons, everything, anything for the packaging material is indirect material. Indirect labor, salesman commission, sales manager salary, indirect labor. Indirect expenses, sales department lighting, whatever, I mean, warehouse charges, go down charges, those all are indirect expenses. So direct is always prime cost and indirect are always overheads. All right. So I hope I'm able to make you understand. Any queries so far? Yes, Rushita, this PPT will be shared with you. I guess it must be shared, but yes, it will be shared with you. Don't worry. All right. Moving further, fixed cost, variable cost, semi-variable. Now, fixed cost is which remains fixed up to a certain, capacity level. Let us say the maximum capacity of the factory is 1,000 units, and this is the factory area, and the rent of the factory area is 50,000. So this factory has a capacity to produce 1,000 units. So till 1,000, now you don't produce anything. You produce 100 units, you produce 500 units, you produce 1,000 units. Whatever units you produce, the rent will be 50,000. That's fixed cost. Fixed cost means it will not change with the output. Clear? So till 1,000, the rent is fixed at 50,000. You lock the factory, you don't produce anything. Like during COVID times, the factory, was locked, but you continue to pay the rent of the factory. Clear? Interest on loan, whether you are doing production or not, bank will not listen. Bank will say you have to pay interest on loan or EMI. So that is a fixed cost. Whether you produce or you don't produce, you have to pay. The fixed cost remains unchanged till a certain activity level. But yes, if you get another order of 500 units, then you have to set up another factory area. And the rent of this factory area is 5,000. So till 1,000, fixed cost is 50,000. But after a certain capacity, fixed cost will increase to 5,000 more. So till a certain activity level, fixed cost remains same. It will not change with the change in the output. All right. So till 1,000 you produce or you don't produce, you have to pay rent. That is fixed cost. Variable is it will change with every unit you produce. You are producing 0, there is no variable cost. You are producing 1 unit, the variable cost starts increasing. All right. So variable cost, raw material. So remember, direct cost is always variable. Clear? Remember, direct cost is always variable. Always remember this. Yeah. The direct cost always variable. So raw material cost, when you produce something, only then raw material cost will be there. Now semi-variable. Semi-variable means to a certain point it's fixed. After that it's variable. Clear? Let me give you the example of electricity bill. The best example. So electricity bill is like till 200 units, you have to pay 1,000. Okay, till 2,000 units of consumption. So if you don't consume anything, your house is locked, you are gone for a vacation for 1 month, your house was locked, there was zero consumption of electricity, but still you have to pay rupees 1,000, the fixed charges. But now you are back from your vacation and your units are 500. So till 200, the electricity bill was fixed. Beyond 200, whatever you are consuming, the electricity bill will come accordingly. All right. So electricity bill is the one of the examples of semi-variable. Semi-variable means both fixed and variable. To a certain extent, it's fixed, and the balance, it is variable. That means to up to a certain level, you have to pay the fixed charges. But beyond that, if you increase further, then it will be variable as per your consumption. All right. So semi-variable, we have to split between fixed and variable. All right. Now, how we do? Briefly, I can explain you. So there are methods which segregate the semi-variable into fixed and variable. So one method, let us go to the methods only. The graphical method, very easy to understand. On the x-axis, there is output. On the y-axis, there is semi-variable. So we are just plotting random dots here, all right? And we just make a best fit line that connects the maximum of dots, best fit line. You cannot, just match all the dots, but the best fit line means it will touch the maximum, the dots. So they are different cost. All right. It's a scatter diagram. It's called a scatter diagram. So you're just scattering different cost, and where it is intersecting this y-axis, that is the fixed cost. So draw a line like this. It's a fixed cost line. So the difference between this line is your variable. So this portion is fixed cost and this portion is variable cost. Clear? And this line is basically total semi-variable cost. Right? So this is how you make a scatter diagram, a graphical method. Let us understand the better methods. Okay, so this is the second method, high-low method. High-low method means we have taken sales value and total cost. So the sales at the highest volume, sales at the lowest volume. All right. So at 1,40,000 sales, total cost is this. So total cost means this is semi-variable cost. You have to break up into fixed and variable. Now the difference of cost and the difference of sales. So 12,000 divided by 60,000. 12,000 divided by 60,000. You will calculate the variable cost. Remember, variable cost is always per unit. Clear? And fixed cost should always be total. All right. So this you should understand. So per unit variable cost, how much will be the per unit variable cost? Basically 20% of sales value. So 20% or whatever you can say, 20% is the variable cost in the sales. So 20% of sales is the variable cost. So 1,40,000 sales, 20% is 28,000. So out of 72,000, 28,000 is variable cost. All right. So that means 72,000 minus 28,000, 44,000 is the fixed cost. These methods are to calculate variable cost. So once you get variable cost, you deduct that variable cost from the total semi-variable cost and you will get the fixed cost. Clear? So again, I'm explaining. Take the difference of total cost and take the difference of sales. Difference of cost divided by difference of sales, you will get the variable proportion in the sales. So 20% is of the sales value. Variable cost is 20% of sales. So sales is 1,40,000, variable cost is 28,000 out of 72,000. So that means fixed cost is 44,000. We can repeat it from the second sales also. 20% of 80,000 is 16,000. So 60,000 minus 16,000 is variable. So that means the balance again 44,000. See, fixed cost remains same. So fixed cost, whatever is the sales value or the sales volume, fixed cost remains same. So we have split the semi-variable into fixed and variable, right? Let's move further. I hope you must have understood this. Just have a final look at this. Good. So let's move on to the next method. This is change in the amount of expense and output. Earlier was high-low. highest sales and lowest sales. Clear? Here is the production of January, the production of February, and the cost of January and February. Clear? So change in the amount of expense, difference in the amount of expense. So 40 and difference in the amount of difference in the units. So 40 is to 40. We are calculating variable cost. Clear? So 40 divided by 40. Variable cost is 1 per unit. It's variable cost. I'm again saying we are calculating the variable cost in the semi-variable cost. So once you calculate the variable, then you split it and you will get the fixed. So 1 per unit is variable. I told you variable is always per unit. So 1 per unit. So 100 units, variable cost should be 100. Clear? So if variable cost is 100, how much should be the fixed? Fixed should be 160. Clear? Here variable cost is 1 per unit. So 140 units, it comes out to 140. So out of 300, 140 is variable, 160 has to be fixed. The fixed cost remains same. So you have to remember is whatever is the method, we calculate the variable cost. Then you find out the amount of variable cost and the balance is fixed cost. And this is the total semi-variable cost. All right, semi-variable cost. So 260 is the total semi-variable cost. Out of that, 100 is the variable cost. You deduct variable cost from semi-variable, you will get the fixed cost. And you apply on both the units or whatever the parameters are given to you in the question. So this is how we have split the semi-variable into fixed. Understood this? We'll be sharing the slide. You can just practice it again and again to just have a understanding of the concept. Moving further, so there's another method of least square method. I think you can practice. Y represents the total cost. So Y equal to, this is MX plus C. C is fixed cost. M is your variable cost. X must be the units. All right, the output, the units. So variable cost is always variable cost into units. Clear? And Y is the semi-variable, the total cost. All right. So this is how you can do. 1200 is equal to 150 is the volume of labor, whatever X is, the units or the number of hours or the number of units. So if you will solve it like this will be cut. So it will be minus 75 equal to minus 50 M. So M will be 1.5. Clear? M is variable proportion. So per hour, variable cost per hour, it will always be per unit, per hour or per whatever it is the unit. Variable cost will always be that. So 1.5 per hour is variable cost, and you know the hours. So here the variable cost, whatever it is, you can calculate. The balance will be fixed cost. Clear? So 1.5 per labor hour is the variable cost in it. This is the least square method, which it's before you. Let me proceed further. You just this you can solve it and calculate. All right. So by controllability, controllable cost and uncontrollable cost. Controllable costs are those which can be controlled by a responsibility center, which are in their hands, all right, which they can control. Uncontrollable are which are not in their hands. All right. So let us say one expenditure, let us say that bus expenditure, the shuttle bus service is shared by all the departments. So that one departmental manager cannot control the cost of a shuttle bus service if the cost is high. So the departmental manager can control only those costs which are in his control. He cannot control the cost which is not in his control or which is shared by many departments. That he cannot control. Clear? So controllable cost is which is in a particular responsibility center which can be controlled by the action of that particular manager. Uncontrollable generally are the shared expenditure which that particular manager of one department cannot control. Clear? So controllable and uncontrollable. I hope there are no queries so far. Normal cost, abnormal cost. Normal cost is something which is inherent, which has to happen. Clear? So if the input is going into a manufacturer, and 10 kgs of wastage will happen. So it has to happen. If let us say I'm into a refinery or oil business, now oil always evaporates, petrol always evaporates. So in that process, evaporation has to happen, and it will happen every time. So something which will happen every time is a normal cost. Something which just happened this time, it never happened and it should not happen, is abnormal cost. Let us say strikes or lockouts, or a fire is there in the department, so there was loss of stock. It will not happen every time. Clear? So normal cost is which has to happen every time in a normal process. Abnormal cost is which not normally is incurred, but due to extraordinary circumstance it is incurred, but next time it will not be incurred. So every abnormal cost is charged to costing profit or loss account, costing profit or loss account, which we will be understanding what is costing profit or loss account. So every abnormal cost is charged to costing profit or loss account. Clear? Moving further, the cost in used in managerial decision making. So these are the costs which and they are interchangeably used, and for managers it is very important. They find out what are these costs. So predetermined costs, of course, predetermined costs are it happens before production. So before production is starting, they will predetermine the cost. This should be the cost. That is predetermined cost. Standard cost, again, what's the difference between predetermined and standard cost? Predetermined cost is, yes, we estimate it before the production happens, but standard cost is managed. Let us say there are a cost of 100 and 200 and 300. So anything might happen, but as per the objectives of the management, they say, okay, keep 200 as the standard cost. So standard cost is that predetermined cost which is calculated from the management point of view, which is actually finalized from the management that okay, this should be the standard cost. Clear? So the management intervention decides that okay, this should be the relevant cost, this should be kept as a standard for performance. So that is the standard cost. Marginal cost is always if I produce that one extra unit. What will be the cost for that extra unit? Let us say the current production is 1000 units. Now I am increasing the production to 1001 unit. What is the cost of this additional 1 unit is marginal cost. So marginal cost is also called as additional cost. It is also called as variable cost, because fixed cost will not increase for that additional 1 unit, but variable cost will increase for this 1 unit also. If I'm producing 1 extra unit, I want 1 extra raw material also. I want direct labor also to produce this 1 unit. So marginal cost is also known as variable cost that changes with 1 unit also. Clear? So marginal cost is that additional cost that you will incur when you add up 1 additional unit also. That what is the additional cost of this particular 1 additional unit is called as marginal cost. Estimated cost. Now, estimated cost is what's the difference between estimated and standard or predetermined cost? See, estimated cost is just an estimate, but standard cost is by expert opinion. Standard cost is a very technical estimate. It's many techniques and methods are used. The past experiences, past records, past statements, past records, the experts' opinions are taken. What should be the standard cost? But estimated cost is just a random estimate. Clear? Estimated cost will be, it can change anytime. Okay, tomorrow the estimate will be different, then the next week the estimate will be different, but standard cost cannot be changed that frequently. Clear? So standard cost is a technical estimate. Yeah, is a very well taken estimate, but estimated costs are just a prospective cost, is just a projected cost that okay, this will be the cost. Standard is this should be the cost. Estimate is this will be the cost. We are making the estimate, this will be the cost. Standard is this should be the cost. I think this should explain you the difference between standard and estimate. Clear? So that is estimated cost. Moving further, differential cost. Differential cost is, let us say we change the method of production. So the cost was 1 lakh earlier. Now we have changed the method of production. Let us say new technology is introduced. Now the cost is 1 lakh 10,000. So the differential cost means the difference of the earlier cost with the present cost. So the differential cost is 10,000. The difference of cost due to different method of production, due to different technology, whatever you are changing. So due to some change in the production process or method or technology, whatever is the difference in the cost is called as differential cost. Now, here in this case, the cost has increased. So it's called as incremental cost. If the cost would have been 90,000, that means the cost has decreased by 10,000. It would be decremental cost. Clear? So any difference in cost, if the cost is increasing, it's called as incremental cost. If the cost is decreasing, it is called as decremental cost. And the difference, whatever, whether the increase or the decrease, whatever is the difference in the cost is called as differential cost. Clear? So it represents the change in the total cost due to a change in activity level, technology, process, method of production. So whatever you are changing, and due to that, because of that, if there is change in cost, that is called differential cost. If the cost is increasing, incremental, cost is decreasing, decremental. All right. Imputed cost. The imputed cost, notional cost, implied cost, implicit cost, opportunity cost, it all means the same. I'm repeating: imputed cost, notional cost, opportunity cost, implied cost, implicit cost. They all mean the same. And what does they mean? They mean they are notional. There is no cash outflow. We are not paying anything, but they are not happening. They do not happen. Because of them, something else is happening. The best example, you can say, the interest on capital. So let us say I have deposited 10,000 rupees in the bank, and I am getting 1,000 as interest. Now I have withdrawn that money from the bank and invested into the business. Will I get that interest from the business? No. So that 1,000 interest which I have lost in that bank because I have withdrawn that money and invested that money into my business, that is imputed cost. That interest which I have lost from the bank is the imputed cost. It is not happening. I'm not paying anything, but that is a loss I have to bear because I have invested that money in my business. I have to withdraw that money from my bank. So imputed cost is where the cost is not incurred, but again the loss is there. So it is not accounting in any books. It is not recorded in any books. That's why it's called imputed cost. Notional. Notional means which does not happen, which is just there for the book purposes. It does not happen. Since it does not happen, it is not recorded. Clear? But it is still a loss to me. All right. Because that interest I have lost because I have withdrawn money from the bank and I'm not getting that interest from my business. I should get interest on my capital which I have invested in my business. I don't get. The second example. I'm running the business in my own house, in the basement of my house. If I would have carried my business in a rented place, I would have paid 10,000 as rent there. But I am running the business in my own house. So that 10,000, if I would have given my house as a rent to some other business, I would have got 10,000. But I am running my own business in my house and business is not paying me rent, that rent of 10,000. My business is not paying me that rent. So that rent is a loss to me. But I will not get that rent. So that is not happening. Since for the business, The business is not paying me rent. It is not it is not an expense for the business. So it will not be recorded. Clear? So that is again an example of notional cost, implied cost, or imputed cost. I hope you got an idea of it. So something which I am losing and I'm not getting elsewhere is I can give you another example. Let us say I am working on a salary of 10,000. Now I am doing a regular course and I have to leave that job. Because of that course, I am losing that 10,000 as salary. That is an opportunity cost. I have to lose that opportunity of 10,000 to select another alternative. Clear? So something which you have to lose because you are doing something else is your imputed cost or notional cost or opportunity cost. Clear? I hope I'm able to make you understand. Capitalized cost. Capitalized cost is which is otherwise an expense, but it will be added to the asset. For example, if I am assembling an asset, or if I'm paying like the installation expense of an asset, loading and unloading charges of a machine, it's an expense, it's not an asset. But loading and unloading charges of a machine which is purchased will be added to the machine only. It is not an expense. So any expense which is added to the cost of the asset becomes a capitalized cost. Clear? So that loading or unloading or installation expense of a machine is a capitalized cost. All right. It's not an expense. It will be added to the cost of the asset till the asset is used. So I've purchased the machine. So till the machine is put to use, any expense which I am incurring on the machine, loading, unloading, repair, logistics, everything will be added to the cost of the asset. Clear? It is not an expense. It will be added to the cost of the asset. That's called capitalized cost. Product cost. Product cost means everything that is added to the product. The raw material, the labor, the expenses, the whole manufacturing cost which is added to the product. Any cost which is incurred for the product is called as product cost. All right. So whatever is associated with the purchase and sale of goods or the product is called as product cost. Acquisition of raw material, conversion of material, manufacturing cost, everything that is incurred for the product is called as product cost. All right. Moving further. Yes, Rashi, very good. You have rightly said. Imputed cost, just like own land, invest in business, or son involved in business activity, of course, that is exactly imputed or implied cost. So good that you have understood the concept. Cost used in making managerial decision making, opportunity cost again, that's the same thing. Value of sacrifice made or the benefit which you have lost because you are doing something else. All right. So I have left the job because I have to do MBA or whatever course you are doing, and you because of that you have to lose your job or salary. Opportunity cost. So opportunity cost of doing a regular course by leaving your job is the salary which you will not get now. That is the opportunity cost. Clear? Out of pocket cost. Out of pocket cost is also called as explicit cost. Explicit means which there will be a cash outflow. So out of pocket cost means ki whatever decision you are making, all right, whatever there will be cash outflow or not. So that is out of pocket cost. For example, I want to let us say we want to make any order, and we have a meeting with the clients. So if that meeting will be successful, what all out of pocket costs which will be incurred, and if that meeting is not successful, what will be the out of pocket cost in the other scenario? So out of pocket cost means whatever decision management takes on anything, whether to produce that asset or whether to buy any asset or whether to take up any customer order, whatever decision the management takes, what will be the cost involved? The cost where there will be cash outflow. For example, if I purchase an asset, depreciation is a cost, but depreciation, you don't pay depreciation. There is no cash outflow. So depreciation is not an out-of-pocket cost. Out-of-pocket cost will be what I have to pay. That is out-of-pocket cost. So whatever management makes a decision, the management will identify what out-of-pocket cost will happen in all the scenarios. Out-of-pocket cost means there has to be some cash outflow where the cash will go out. All right. So that is also called as explicit cost. Shutdown cost. Shutdown cost means, again, the best example of shutdown cost is rent. So if the factory is closed, like for 2 years, the factory were closed during COVID, but you were continuing to pay rent. So shutdown cost means even if you are temporarily shut down your business, the cost which you still have to pay, which you still have to incur, like depreciation, machines will run out. Machines will wear and tear, whether you use them or not. So shutdown cost means when the business is temporarily shut down, what all cost you still have to bear. Interest on loan, EMI which is going, you have to pay them. So shutdown cost, yeah, which cannot be avoided due to temporary closure of the plant or the factory. That is the shutdown cost. Sunk cost is cost which already you have. The best example of sunk cost, research and development cost. Let us say you spent 1 lakh on research and development, and that research and development was a failure. Can you do anything of that 1 lakh? It's gone. It's a sunk cost. You cannot take that cost into any decision now. That cost has been incurred and you have suffered a loss. Your research and development was a failure. So that means that's a sunk cost. You cannot do anything. Clear? So sunk cost, they don't play any role in decision making. So any replacement of a machine or whatever you have incurred in the past is a past story. It cannot affect your decision making today. That is a sunk cost. All right. Absolute cost. Absolute cost means when you calculate the cost in total, absolute terms, not in percentage, in absolute amount. How much is the total cost of a product? 1 lakh. How much is the cost of raw material? 50,000. How much is the cost of labor? 20,000. You know the amount in absolute value. That is absolute cost. Anything which you calculate in percentage is not absolute cost. It's called relative cost. Clear? So absolute cost is when you calculate in absolute rupee terms. That is called absolute cost. Discretionary cost, I gave you example. Discretionary cost means when there is no clear cost benefit relationship, like advertisement expenditure or R&D expenditure. If there is increase in sales, why there is an increase in sales? Due to expenditure. How much the increase in sales is due to expenditure? Discretionary. That means there is no clear-cut cost and benefit measurement. You cannot exactly measure what is the benefit coming out of that cost. R&D, advertisement expenditure, they are the discretionary cost. All right. Period cost. Period cost means which are not related to product. They are charged to period. Rent. Rent is the best example of period cost. Rent is not associated with the products you are making. Rent is associated with the time period. 5,000 per month. It is not related to 5,000 per product A or product B. So any cost which is related to the time period. All right. Depreciation, if it's related to time. Interest, it's related to time. Rent, it's related to time. They are called period cost, not product cost. Engineered cost. Engineered costs are where you have a direct relationship between input and output. Direct cost and benefit analysis you have. All right. So this much input has to give this much of output. Where there is clear-cut measurement of input and output, that is called engineered cost. All right. So all the cost of production, direct material, direct labor, So they are exactly, if 1000 input is going into it, so 500 output should be out of it. So clear cut cost and benefit, that are engineered cost. Explicit cost, I told you, out of pocket cost, where there will be a cash outflow. So whatever expenditure you are making in cash, salary, rent, telephone, electricity, repairs and maintenance, anything which you are paying in cash and are recorded in the books are called explicit. I'm repeating. Explicit costs are those you are paying in cash and also you are recording in the books. That is called explicit cost. Implicit cost, I told you, implicit, notional, implied, they are no cash outflow and you are not recording them. So clear cut difference between explicit and implicit. Explicit, there is cash outflow and you are recording in the books. Implicit, notional, implied cost, imputed cost, they are notional and they are not happening. They are not, no cash outflow, they are not recorded. Clear? So I hope you have understood all the types of cost. This exercise, I think you can do it. Okay, so now we have moved on to the methods of costing. Single output costing. Single output costing means there's one product, like one bicycle. Single costing. Single method of costing is used. So how many bicycles? 10 bicycles. So single output costing method. Batch costing. I told you the best example of pharmaceutical. Medicines are manufactured in batches. One strip is not manufactured. 1000 strips must be manufactured in one batch. If you just observe, when you buy the medicine, they always make the bill and they write batch number. That means that strip of medicine which you are purchasing was manufactured in that batch. Must be 1000 strips of that medicine must be manufactured in that batch. So batch costing is the best example of pharmaceutical medicine industry, where the manufacturing is in batches. Job costing, job means one particular job. So job costing or customer order. So if I'm working on one job of a customer, so then the job costing. So let us say if I take the orders, the special orders only, I don't manufacture it randomly. I just manufacture on the basis of orders from the customer. So customer 1, customer 2, customer 3, customer 4. So the job which customer 1 has given me is the job of that customer. So I will do the job costing of that customer. So whatever I'm doing for that customer, I will accumulate all the cost incurred on that particular job. So job costing, all right? It's based on customer order. Contract costing. Contract costing, best example, construction. Road contract, building contract, bridge contract, school building contract. So when the builder has got a contract based job or a work, is called contract costing. So the separate account will be made for road project, separate account will be made for building project. All the cost for road project will be accumulated at one place. All the cost for building project will be accumulated at one place. So contract based costing. Clear? Process costing. If a product is manufactured in 3 processes, process 1, process 2, process 3. So one product passes through 3 processes. We do costing for separate process. You will understand. See, every method of costing is a module for you. There's a module under process costing. There will be a module on the contract costing, operating costing, job costing. Every method of costing is a separate module, a unit you will be learning in your subsequent modules. All right. Operating costing is in a service industry, like transport industry, hospital industry, and hospitality industry. So operating costing happens there. You will be understanding when you will be doing the, transport, passenger kilometer, how much kilometers you are being traveled, water, retail trade, operating hospitals, nursing facilities. So it comes under operating. Multiple costing, when there is a combination. So there's an example, like we are producing the bicycle and we are also producing the parts. So parts will be produced under batches and then this part will be used under single costing. Clear? So combination of two methods of costing. So if I am manufacturing the parts of the bicycle also, parts will come under batch costing. You cannot produce one part at a time. 1,000 parts of a bicycle will be manufactured in one lot. So batch costing plus bicycle will be under single costing, one bicycle at a time. What is the cost of one bicycle? So combination of costing methods. All right. I hope you've understood. So this, I think it is an example you can see. Okay, so technique costing, I think the last segment of the session. Uniform costing is when basically you follow the same process, the recurrent, same type of product is manufactured every day. So the uniform costing and when all the companies in one industry are following the same method of costing. Clear? So that is uniform costing. Let us say there are 5 companies. So let us say there are airlines companies. There are 5 airlines. So all the 5 airlines are using the same method of costing. That is called as uniform costing. All right. So that we can compare the cost of all the airlines. And what is the cost of different airlines? So when we are following the same system of costing. Marginal costing, I told you will be learning marginal costing. It's very important module. So in the marginal costing, we understand the costing of a single unit, additional unit costing, variable. So the cost is split into fixed and variable, and we concentrate more on variable cost because fixed costs don't change that rapidly. Standard costing is when you compare the standard cost with the actual, and then of course standard costing is all about cost control. Cost control means you set up the standard, then you make the actual thing happen. You compare the standard and the actual, and you understand the variance. Why the deviation? Why the difference between standard and actual? That you will be studying under standard costing variance analysis. So every technique you will be understanding in detail in different modules. And then historical costing, it's based on past records. So historical costing, absorption costing, when we take total cost method, total cost. We don't split into fixed and variable, we take total cost. So that is absorption costing. So I think that's enough for today. I hope you've got an idea of what the introduction of cost and management accounting is all about. What are the terms you will be coming across in subsequent modules? What are the methods and the techniques you will be? So the last 2-3 slides you will be actually this is your cost and management accounting. The way cost and management accounting is all about various methods and techniques of costing. Uniform costing, absorption costing, marginal costing, standard costing, batch costing, job costing, process costing. So much costing will be coming your way in the next module. We'll starting with the first the unit in the next session. So that's all for today. Hope you must have got a happy learning, and see you in the next session. Till then, thank you and goodbye.